Hi, this is Melissa Talley.
And I'm Andrew Harward.
This presentation is for our Law 2150 class at Appalachian State University. Today is December 1st, 2014, and the topic we decided to discuss is the taxation of internet sales. If you asked a room full of people if they had ever made an online purchase, all of their answers would probably be yes. If you got more specific and asked the same group of people if they had ever made a purchase from Amazon, they would probably answer yes again. If you asked the same group of people one last question, that being if they paid sales tax on their Amazon purchase, they would more than likely answer no. But why is this the case? Don't we pay sales tax on all the purchases we make? The answer to that question is no, and that is what we want to discuss today. At first you may be wondering why the taxation of internet sales is an issue at all. As more businesses begin to sell their products online, issues begin to arise. Companies who make sales over the internet are not required to pay or charge state sales tax if the buyer of their product is located in another state, and the seller does not have a physical presence in that state. This proves to be beneficial to strictly internet-based companies, such as Amazon and Overstock.com, because neither of them have a physical presence in most states. Therefore, customers are able to make their purchases tax-free. Not having to pay sales tax gives internet-based companies an unfair advantage over stores with physical presences. The chart above explains the process which determines whether or not a company is required to pay sales tax. Since this project is for business law, we also wanted to explain how it relates to the course. The business aspect of this issue is obvious. All stores with a physical presence are required to charge sales tax on their sales. So why shouldn't internet sales be taxed too? When looking at the legal aspect of the issue, the law comes from the Due Process Clause of the Constitution, which states no taxation without due process of the law.
So, why does this matter? The world we live in now relies more heavily on technology than ever before and continues to rely on it more every day. With this constant increase in technology, more companies are beginning to sell their products online. It is estimated that online sales are increasing by 300% per year. And as you can tell from this graph, it is projected that online sales will continue to increase in the future as well. By selling their products online, companies are able to expand their markets by selling their products to buyers in different states across the country. Of course, as online sales continue to grow, so does the amount of uncollected online sales tax, as you can see from this graph as well. Tax-free internet sales are doing more than just hurting small businesses, though. States rely heavily on tax revenue as a part of their yearly income, as it makes up a whopping 1/3 of states' yearly revenue. In 2003, states' sales tax revenue fell by $13 billion. Additionally, the average overall yearly reduction in sales tax revenue caused by e-commerce is $11 billion per year. This is no small number, and it makes it clear how much tax money affects the functionality of the government.
So what is the government doing about this, and why doesn't the government just start making companies charge sales tax on internet sales? In 2013, the New York Department of Taxation and Finance tried to impose sales taxes on Overstock.com and Amazon.com for purchases made in New York. Both companies are completely internet-based. Therefore, they were only required to collect sales tax in the states in which they had distribution centers, or a physical presence. Since neither company had a physical presence in the state of New York, neither one of them were required to pay sales tax. In this case, the court ruled that it was unconstitutional to require the companies to charge sales tax because it violated the Due Process Clause, which once again requires companies to have minimum contacts with a state to be required to pay sales tax. Also in 2013, the Marketplace Fairness Act was implemented. This act requires companies who make more than $1 million per year in internet sales outside of their state to pay sales tax. They cannot have a physical presence in the state for this to apply, and this is the only policy that has been enacted so far which requires companies without a physical presence to pay sales tax. Though there has been a lot of emphasis on this issue recently, the topic of taxation of internet sales is not a new topic. The Internet Tax Freedom Act was enacted in 1998, and it banned the government from imposing discriminatory taxes on internet commerce. While consumers are technically responsible for paying taxes on out-of-state internet purchases, this is done through self-reporting. With self-reporting, most consumers do not even report these purchases, therefore making them basically tax-free.
Our group decided to focus on whether or not it should be legal for states to be able to require companies to pay sales tax when making sales in their state. The main statute which prevents states from being able to impose sales tax on companies making sales in their state without a physical presence is the 14th Amendment. This amendment states no taxation without due process. The 14th Amendment has been the basis for all court case decisions ruled against taxation. Another court case which ties into the 14th Amendment is Quill versus North Dakota. In this case, Quill's headquarters were in Delaware, a state which does not charge sales tax. Quill sent lots of their products to North Dakota. The company did not have a physical presence in North Dakota, so they did not have to pay sales tax. North Dakota claimed that Quill should be required to pay sales taxes. The verdict once again, though, was based on the 14th Amendment, and the court sided with Quill.
According to Rachel Collins, an expert in the field, there are many complications that would come along with imposing taxes on internet sales. Since the internet did not exist during the writing of sales and use tax regulations, the system is not built to accompany such taxes. With this said, in the United States there are 8,000 different taxing jurisdictions. Among these jurisdictions, each one determines the bases, rates, and exemptions for their jurisdiction. Sammy Tequila and Robert Strauss are also experts in the field and extremely against the taxation of internet sales. Their research shows that at most a mere 3.1% of the tax base is potentially at stake, and that any tax policy would only have a minimal impact on consumers' welfare. Additionally, they claim that e-commerce could shrink from 20% to 40% if sales tax were implemented on internet sales. Though it would be more beneficial to small businesses and state governments for companies to be required to pay sales tax on internet sales, at this time the truth of the matter is that it is simply unrealistic. With the 14th Amendment of the Constitution and over 8,000 different taxing jurisdictions, the work it would take to implement sales tax on internet sales is a larger risk than a reward. As more companies begin to sell their products online, their revenue is increasing and they aren't having to give any of those earnings back to the states. Although it would be beneficial to states as well as businesses with a physical presence, it is simply too difficult and unconstitutional. According to the 14th Amendment, a business must have minimum contacts with the state in order for them to be able to charge sales tax without a physical presence. The fight is nowhere close to being over, though. This will surely continue to be a popular issue in the media. We hope you enjoyed our presentation. Thanks for watching.